Okay. Like I said, assets are things we have that the company has. Liabilities are things that the company owes. And stockholders' equity is things that the company owns. Well, we own the common stock, and we also own retained earnings. Retained earnings is profit. Pure profit that maybe we had, but we just started this company. So at the beginning of the year, our retained earnings or profit is 0. We have nothing in that account. So that's sitting there right now. However, you see the little green box around the next 2 T accounts, and although it's hard to read, it says income statement right there. Income statements accounts are equity accounts. All revenue account, whether it be sales revenue from selling our actual lemonade jars, or service revenue from selling our services, such as a lemonade tasting, would be revenue, sales revenue or service revenue. The cost of doing business would be expenses. Revenue minus expenses goes on the income statement. So, and down at the very bottom, you see statement of retained earnings. Dividends are also an equity account, and so they can be put here. All right. So let's essentially, first of all, just look at those 5 key accounts going under equity: stock, common stock, retained earnings, revenue, expenses, and dividends. And we'll start with some equity transactions. Okay, so that person's birthday comes, and we actually go out to their house and we do a lemonade tasting. Well, that unearned revenue we have now earned, haven't we? We've received the cash for it, but we don't owe them anymore, do we? Well, guess what? We have to take it out of liability and put it in revenue. Now, there are some rules for revenue. To claim something as revenue, it must be earned. Well, if we've done the lemonade tasting, we've earned that revenue. If they've walked out with our lemonade jars, our inventory, we've earned that revenue. We did our part. Once we've done our part, we can claim it as revenue, whether they've paid or not. We get to claim it. So, guess what? We're going to take it out of unearned revenue by putting 1K on the debit side, which zeroes out that account. The balance is now 0. And guess what? We debited that. We're going to credit revenue 1K. We have now moved it out of unearned revenue. We have no unearned revenue anymore. And we now have earned revenue of 1K. The cash is untouched because they paid us ahead of time. All right, so that's one equity transaction. Another one is, what if someone just walks into our store, the little shed we're renting, and buys some of our lemonade jars? A whole bunch of it. They buy $5,000 of lemonade jars. Well, here's the thing. It cost us $5,000 to make that lemonade and put it in the jars and do all that sort of thing. That's our cost. Are we going to sell it for what it cost us to make it? I don't think so. So they walk out with our inventory. Now, I'm going to do this in a different color because this is very unique. We're not just going to have 2 accounts that are affected. We are going to have 4 accounts that are affected when someone walks into your store and walks out with your inventory that you paid a certain amount for, but you charge a profit. Guess what? It's going to affect 4 accounts. So first of all, let's say Joe Blow walks in with a credit card and buys $5,000 of our inventory, and our markup is double. It costs us $5,000 to make that lemonade, but we charge $10,000. So He pays with a credit card. So this is accounts receivable up at the top. First thing that's going to happen is he is going to owe us $10,000, isn't he? $10,000. I'm going to put 10K there of an account receivable because he ran his credit card. He didn't pay us cash. He ran his credit card. He owes us on account. Gave us a big fat IOU. So accounts receivable are $10,000. He owes us that much. But how much of our inventory did he walk out with? Well, inventory is at cost. Let's look at inventory. He walked out. Inventory goes down by only the value of what it cost us. $5,000. We're not in balance anymore, are we? Well, I did tell you there's 4 accounts that are affected. The amount we're going to collect, the account receivable amount of 10K, that's raw revenue. We collected 10K. Revenue, go over to stockholders' equity, revenue's going to go up by 10K. So now our 10Ks are in balance. We have a 10K debit and a 10K credit. But now we have a 5K credit in inventory, and we know we need a debit somewhere to balance out that credit of 5K. Here's where, back in video 2, I told you there was 2 exceptions to the heart, to the feel the love heart rule. And guess what? The exception equals expenses. So EX goes to EX. Expenses, to increase an expense, they function like an asset. To go up, you must go out on the left side. So guess what? Our expenses are 5K. We get to expense the $5,000 that we put into making that inventory. So expenses are the exception. But there is one other exception that functions a little like expenses, even though it's not an expense, and that is dividends. Both of them are money out, and that is why they act opposite. So dividends also, to increase, acts like an asset and gets debited for an increase. So everything else on the right side of the equal sign gets credited for an increase. But expenses and dividends act just like assets. They get debited for an increase. So, back to this problem, we would debit accounts receivable and credit revenue. That's the money we're collecting. He's going to pay us with his credit card, 10K, and we're going to claim 10K of revenue. But he walked out with 5K worth of our inventory, and we get to expense 5K of our inventory. So, those are the 4 accounts affected when somebody walks in and walks out with your inventory that you sold for a profit. Now, it might not be account receivable. It might be cash if they paid cash. But generally speaking, those are going to be the 4 accounts. I told you stockholders' equity could get a little confusing. Let's do one more. It's time to pay the electricity and water bills, utilities bill. Well, what do we pay bills with? We have to pay them with cash. They won't accept anything other than cash. So when you have something like that, a big fat bill lands on your desk, we're out the cash. So let's say our utilities bill was $2,000. We use a lot of utilities making lemonade, apparently. We would be out the cash, 2K. So my pen's still red, so you can see me over there on cash, crediting cash for 2K. We expense it immediately. It's a cost of doing business, just like the cost of selling our inventory was. So we would put 2K on expenses right there. So that's how that works. I hope this is easy enough for you to understand. I've done a bunch of transaction analysis examples. Remember that the exception to the rule of everything on the left gets debited to increase and everything on the right gets credited to increase. Remember the exception. Expenses and dividends function a little like assets. The exception is expenses and dividends. So, this is Professor J out from Transaction Analysis. I hope this helps, and I'll see you in the next video for adjusting entries. Bye-bye.